3 weeks after David died, Carol finally opened the mail. There'd been a funeral to plan, calls to make, a house that suddenly felt too big and too quiet at the same time. The mail could wait. That's what she told herself. Grief has its own schedule. But somewhere in that stack was an envelope with a return address she didn't recognize, and inside it was a deadline she never knew existed. 9 months, starting the day David died, and by the time she opened it, the clock had already been running for 3 weeks. The letter mentioned something called an estate tax return. Carol almost laughed. She and David were school teachers. They had a paid-off house, some savings, nothing close to what she thought estate tax meant. So she set the letter aside, back under the sympathy cards, and told herself she'd deal with it once things settled down. Surely this was for other people. People with mansions and stock portfolios, not people like them. 6 weeks became 10. The letter sat forgotten, buried a little deeper every time a new stack of mail landed on top of it. And that assumption, the one that felt so reasonable, was quietly costing her more than she could imagine. It was her daughter who finally pushed her to call someone. Not because she suspected anything was wrong, just because someone should probably look at Dad's paperwork. Carol resisted at first. She didn't want a stranger going through David's things, sorting through 40 years of a marriage like it was just numbers on a page. But she made the call anyway, sitting on the edge of the bed with the phone against her ear, half expecting to be told there was nothing to worry about after all. The CPA read the letter Carol had almost thrown away, and her expression changed. "Do you know what portability is?" she asked. Carol didn't. So the CPA explained it simply. When a spouse dies, the federal exemption they never used doesn't just vanish. It can be passed to the surviving spouse, potentially protecting a meaningful sum for Carol, or for her kids, or her grandkids someday. But only if the estate files that same return, the one Carol had set aside within 9 months of David's death. Not because they owed a dime in tax right now, just to preserve the option, permanently, before the window closed. Carol sat with that for a moment. "So we don't owe anything, but we still have to file?" The CPA nodded. That's exactly the trap. Most people hear, "We don't owe estate tax," and stop right there. The filing isn't about this year. It's about protecting an option you might never even need, until one day you do. Let's pause the story here for a second, because this is worth understanding clearly, not just as something that happened to Carol, but as something that could genuinely matter to you. Here's the first thing worth knowing. The federal estate tax only applies above a specific exemption amount, and that amount is large enough that most families never owe a dollar of it. That threshold also changes most years, adjusted for inflation. So if you're doing your own research on this, don't trust an old number you find somewhere online. Check the current figure, or better yet, ask a CPA directly. But here's the part that trips people up. Not owing the tax and not needing to file anything are two completely different questions. Portability, the ability to pass along a deceased spouse's unused exemption, only exists if the estate files that return within the 9-month window, even when the tax owed is exactly 0. Skip the filing because we don't owe anything. And in many cases, that unused exemption simply expires. It doesn't roll over. It doesn't come back later. It's just gone. Here's the second thing worth knowing, and it's a distinction almost nobody explains clearly. Not everything you inherit gets treated the same way by the tax code. Assets like a house, stocks, or other property you inherit generally get what's called a step-up in basis. Their value effectively resets to what they were worth on the date of death, which can significantly reduce the taxable gain if you sell later. That's real, and it's valuable. But retirement accounts, things like a traditional IRA or 401k, don't work that way. Money withdrawn from those accounts is generally still taxable as ordinary income, step-up or no step-up, because that money was never taxed on the way in. Knowing which of your assets get that reset and which don't isn't just trivia. It changes what order it makes sense to spend things down in, and it's exactly the kind of question worth asking a professional before you need the answer, not after. Here's the third thing, and this one has nothing to do with the size of an estate at all. Many states have their own estate or inheritance taxes, completely separate from the federal one, and several of those state thresholds are dramatically lower than the federal exemption. A family that comfortably clears the federal threshold with room to spare might still owe something at the state level and never realize it, simply because estate tax in their head means the federal number they half remember hearing about once. Where you live matters here, every bit as much as what you own. And the fourth thing, the one that actually caught Carol off guard the hardest, has nothing to do with tax code at all. It's about who controls what. The CPA handed Carol a list. Not a complicated one, just the paperwork every estate actually needs, gathered in one place instead of scattered across drawers and filing cabinets. Certified copies of the death certificate, statements from every bank and investment account, the deed to the house, life insurance policies, and one item that stopped Carol cold: the beneficiary forms on David's old retirement account. See, many people assume a will controls everything. It doesn't. Retirement accounts, life insurance, and many bank accounts pass directly to whoever is named on the beneficiary form, regardless of what the will says. It's a legal principle worth remembering. The beneficiary form wins every time, no matter what the will says underneath it. David had opened that retirement account years before he met Carol and never updated the form. If they hadn't caught it, the account wouldn't have gone to Carol at all. It would have gone to someone from a chapter of his life that had closed decades earlier. They fixed it that same afternoon. One form, 5 minutes. A mistake that had sat quietly for 20 years, corrected before it became permanent. Before Carol left, the CPA mentioned a few smaller things too. The kind of quiet, practical steps nobody thinks to Google in the middle of grief. Notifying Social Security so payments don't get overpaid and later clawed back. Updating the homeowner's insurance and utility accounts so they're not still listed in David's name alone. None of it was complicated. All of it was easy to forget. Carol had 11 days left on the original deadline. What followed wasn't dramatic. It was just work. Pulling statements, signing where the CPA marked, filing with 6 days to spare. No windfall, no headline, just a door that stayed open instead of quietly closing behind her, and a beneficiary form that now said the right name. 6 months later, Carol sat across from a friend who just lost her husband too. And instead of saying, "I'm so sorry," and leaving it there, Carol found herself saying something else. "Have you opened all your mail yet?" Her friend blinked, confused, the same way Carol once had. So Carol walked her through all of it, slowly, the way someone had once walked her through it. The 9-month window, the portability election, the step-up in basis, and which accounts it doesn't apply to, the state-level rules worth checking, the beneficiary forms nobody thinks to check. Not as a lecture, just as someone who'd already been through the version of this story where it almost went wrong and wanted her friend to have the version where it didn't. That's really what this comes down to. Carol didn't become an expert. She just became someone who knew enough to ask the right questions and who knew who to call when she didn't have the answers herself. So here's the actual takeaway, and it applies whether you have a paid-off starter home or a portfolio David and Carol never imagined. A few things this week. Find out who your family's CPA or estate attorney would be if something happened tomorrow. Not someday, this week. Pull up the beneficiary forms on your retirement accounts and life insurance and actually read the names on them. Ask whether your state has its own estate or inheritance tax, separate from the federal one, and put copies of the documents that matter, the deed, the policies, the account statements, somewhere one other person in your life knows how to find. None of this requires wealth. It just requires a little time and the willingness to think about a hard day before it arrives. Carol's story isn't really about a deadline, or a form, or even the money. It's about the difference between reacting to your worst day and preparing for it. You don't have to have all the answers, you just have to know who does, before the day you need them. If this helped, tell me, do you know who your family would call? And if you want to go deeper on building that kind of preparation into your finances, that's exactly where we're headed next week. Because the best time to ask these questions is long before you ever need the answers.